What is going on? What's happening, people? You having a good day? Me too. Look, a lot of people come to this channel. A lot of people hear my story. They hear the success that I've had in the stock market. They've heard about success that some of my students have had. It's very, very important. The stock market, there's real money at play. We're not talking about paper money, right? We're talking about real money that's in play every single day. And now, even with the advent of futures, with the advent of Bitcoin, there's a lot more pre-market and post-market trading. Your hard-earned dollars in the stock market are in play for more time than ever before. So a lot of people come to this channel, again, they see my results, and they want to immediately do that. But the reality is, in the stock market, in investing, if you do not crawl before you walk, and then after that, if you do not walk before you jog, and then after that, if you do not jog before you sprint, it's very, very likely that you could take some serious losses, and what's worse, completely give up on investing. So it's very, very important that on this channel, we hammer home the basics. There's going to be a lot of information on this channel about serious making money strategies, but it's very, very important. While it is important to watch those, it's also very, very important to hone your skills, to really get back to the basics. So there are two things that I do. Two things that I do before I enter any trade or any investment. And they have kept me around for this long. I promise you, I would not have been able to have the success that I've been able to have if I didn't follow these exact two things before I entered every single trade or investment. They're very, very important. You guys should focus. You guys should write these down, and you guys should be doing these before you enter any single trade. So what did I call this? The two simple steps you need to do. You need to make before you enter a trade. And I'm telling you guys, it's going to save you so much money. It's going to save you so many headaches. And ultimately, it's going to keep you in the game. So when you really get it, you're going to be able to kick some serious butt. So guys, very, very important that you focus on this one. It's going to be really fun. Two simple tricks. That's right. Two simple steps you need to make before you enter any trade. I'll see you guys inside the computer. Okay, YouTubers, here we are. Here we go. The two simple steps you need, it's in all caps because you really need it. You need to make before you enter a trade. Now, a lot of people are going to watch this video. A lot of people are going to come to this channel. A lot of people are going to listen to this, and they're going to think, man, you know what? That's not sexy. Man, I've heard way cooler things out there in terms of what you need to do before making a trade. I heard about this indicator. I heard about this chart. I heard about this algorithm. I heard about all these crazy things. And Steven, this isn't sexy. I get it. The reason I've been so successful in the stock market is because I have done nothing sexy. I've done the same thing that works over and over and over again, and I do it every single day. That's why I've been so successful. That's why I've been able to take just a few $1,000s and turn it well into the millions. Because again, I do simple things that make a lot of sense, that are very basic. I do them every single day without fail, and I'm able to generate some substantial wealth starting out with very little money doing that. So I'm going to warn you guys before we get in this video, it's not sexy, but if you're out there looking for the latest and greatest, I guarantee you're not going to find anything that really works. Think about Warren Buffett. You think that dude's sexy? The way he talks about investing? He's like, yeah, just find companies that are cheaper than they're worth and buy them. He's like the second wealthiest person on the planet. That's not sexy, but a lot of people would go out there and they'd be like, yeah, this charting software is really awesome. It's definitely better than advice from like the guy who's worth 50 billion. I have used these two simple steps before I've made every trade for the last decade, and I guarantee that I would not be sitting here with the type of money that I've been able to make, excuse me, that was a tongue twister, that I've been able to make if I did not do these two simple things before I make any trade. We have a ton of strategies that are profit-killing strategies, where we're crushing strategies, profit-crushing strategies. We have a ton of that content here. But make sure you are going ahead and following these two simple steps before you go ahead and implement and execute all those profit crushing strategies. It's very, very important. These two simple steps are a big time money saver, are a big time money saver. And a penny saved is a penny earned. So let's get into it. Well, what's the problem, right? In order for me, and the reason why I have to do these two simple steps, and the reason I think you and every investor out there needs to do these two simple steps is because there is a legitimate problem. Investors and traders sometimes, and sometimes is a very loose term because sometimes it could be replaced very easily with all the time. But investors and traders sometimes rush into investments or trade. The reality is there are only a few things in the stock market we have total control over. Right? We've talked about them plenty before on this channel. There are only a few things in the stock market that we have control over. But because there are so many things in the stock market that are out of our control, we have to make sure everything we do have control over, we're doing it the right way. We're doing it to the best of our ability. If there are 5 or so things that we have control over in the stock market, and on every single trade or investment, we're 5 for 5 with those, we're going to give ourselves much better odds of making money. Now, here's the big problem. Here's the big problem, and here's the reason why these two simple steps are very, very important. The problem is that people throw their money into investments or trades because they feel like they're going to miss out on the next big thing, while at the same time not understanding what their risk truly is. Now, I'm going to repeat that 5 or 6 times. And while I'm doing that, I want you to think of all the investments or trades. If you have your own account, I guarantee you, you have gone through this before. And if you haven't, you're lying to me. And if you don't have your own account and you've ever spoken to anyone about the stock market, I guarantee you they have done this too. And this is the major problem. This is the single major problem in the stock market and the reason why I force myself to do these two simple steps before every single trade or investment that I'm going to talk to you guys about here in a second. But the problem is that people throw their money into investments or trades because they feel like they're going to miss out on the next big thing, while at the same time, they don't understand what their risk truly is. This happens so frequently, it's nauseating. So the problem is people throw their money. Well, first of all, they throw their money. They don't really think it through into investments or trades because they feel like they're going to miss out on the next big thing. If you hear a stock tip from one of your friends or from Jim Cramer, it's very unlikely that you go ahead and do your research. If you hear that a stock is going parabolic, is shooting up, is up 5%, 10% day after day, you don't really care why that's happening. You don't really care that it's even happening. All you care about is the fact that you heard that someone else was making money from it, and you don't want to miss out on that next big thing. And when you're doing this stuff, you're throwing money and chasing, you're not understanding what your risk truly is. Again, guys, people think the stock market is this crazy, crazy thing where you have to be a finance major, where you have to really know about stocks, where you have to know how to read charts, where you have to have a crazy math background, right? Where you have to have a ton of risk tolerance, right? We just broke down the biggest problem in the stock market to one sentence. Very basic, very conceptual. And again, guys, that's why I've been able to make a lot of money in the stock market, because everything to me is very conceptual, very, very basic. Anything that's advanced, I don't worry about. So the problem with investors in the stock market, and specifically non-professional investors, we call those retail investors. The problem is that they throw their money into investments or trades because they feel like they're going to miss out on the next big thing, while at the same time not understanding what their risk truly is. That's the problem. And what are the two simple steps? The two simple steps that I do before I make every single trade or investment. So again, guys, there are only a handful of things we can control in the stock market. But fortunately, by doing these two steps myself, I've been able to significantly reduce my risk over a decade worth of doing this. So what are our two simple steps? And again, big warning, big flashing red warning. If I knew how to do better videos, I would have like a huge red warning on this video. these are not sexy. You might not be like, oh man, like these aren't crazy, like these aren't charts, these aren't Fibonacci, these aren't something crazy. I'm telling you guys, simple works. KISS. Keep it stupid simple, or keep it simple stupid, whatever it is. The simpler, the better. Here are the 2 simple steps that I do before every single trade or investment as a cure for the problem being that people throw their money into investments or trades because they feel like they're going to miss out on the next big thing, while at the same time not understanding what their risk truly is. So for the first part of that, people throwing their money into investments or trades because they feel like they're going to miss out on the next big thing, my solution for that is, if purchasing stock, we are going to put in an order below the market. And for the second half, while at the same time not understanding their risk truly, in order to fix that, when I purchase a stock, we have to take our trade size and make sure that it is not larger than 5% of the total value of the portfolio. Again, those are the 2 simple steps that I do before I make every single trade or investment that completely cure the number 1 problem with investing. And we're going to start breaking those down a little bit. So the first thing that we said is we want to put an order below the market. Now, what is a market? A market, this is what a market looks like in Google. On one side, on the left side, we have the bid, which is at 1052.71. The bid is the most amount of money that someone is willing to pay. That's what the bid is. That is one side of the market. On the other side, we have the ask, 1053.21. The ask is the lowest amount of money someone is willing to sell for. We have buyers and sellers all looking to buy and sell the exact same thing. In this case, shares of Google. That is what a market is. Now, the rule, we want to put in our order below the market, right? Below the market would be below the bid and the ask. So let's look at a couple of examples, right? Any bid below 1052.71 would be considered below the market. Now, if we look at a couple of stocks that are out there today, let's look at Facebook right now as an example. So Facebook, let's see. Right now, the market in Facebook, excuse me, this might take a moment. The market in Facebook is people are willing to bid 179.21 and ask 179.45. So if we wanted to go ahead and put in a bid below the market, well, it would have to be a price below 179.21, like a price like, I don't know, 179.20, for example. That is below, and we're going to hear why in a second. So why? The reason putting your buy order below the market is it allows us to get a better price than the market currently offers. So again, the big problem is people feel like they're missing out. People feel like they're going to miss out on the latest and greatest. They throw their money in there because they feel like they're missing out on the next big trade. Now, doing this, putting in an order below that, allows us to not chase, right? It allows us to not chase. And further, our studies show us that buying stocks when they are down is more profitable than buying stocks when they're up. So if we look at Google, right? If we place an order below the bid, let's say 1052.70, that is buying when a stock is down, right? And as our numbers all show, and as our data shows, that when we buy stocks when they are down, we have a more profitable opportunity than buying stocks when they're up, right? Now, it is clear that this concept of buying stocks when they're up as opposed to buying stocks when they're down happens all the time. What we're looking at right here is the red is the price of the S&P 500. The blue is the margin debt. So as more people buy stocks And as more people have more stocks in their portfolio, the margin debt goes up. So as you can see here, as stocks are going higher, people are clearly buying more stocks. And as stocks are going down, people are clearly selling more stocks. So this is very, very interesting. When markets make a top, people have bought the most amount of stocks. They have the greatest amount of long exposure. And when markets make a bottom, they have people with the least amount of stocks held. And margin hits a bottom. This is very, very interesting. People do the opposite of what we're talking about here. We're saying put in your order below the current market so that the market sells off into your order. But here we're seeing that the herd is not doing that. The herd is doing the opposite. The herd is buying as stocks are going up and selling as stocks are going down. But our rule is buy when stocks are going down. And why do we say that? Well, again, rather than buying stocks when they're up and selling stocks when they're down, we want to reverse that, right? And we want to buy when stocks are down and sell when they're up. So we said the first simple thing that I do before I enter trade, the first simple step I do before I enter trade is putting in my order below the market. That would be me buying stocks when they are down, because the stock has to go down in order for me to get filled. Now, the study that we talk about a lot in this channel is if a stock is down more than 5% over a 10-day period, it is far more likely to reverse and go higher to the tune of 70% than it is to continue to go lower. So the problem is that people chase stocks up. Clearly they chase stocks up. As stocks are going up, they're buying more stocks, but they're getting in at a horrible price. So the simple step to combat that, to fix that, is put your orders in below the market. This way, you'll only buy stock if stocks sell off. And as we know, we have a huge advantage of buying stocks when they're down. They're far more likely to go up than they are to continue down after they sell off. So that's the first part of this. The second part of this is people don't understand their risk. And the way to do that is to shrink our trade size. So trade size that is too big adds excessive risk, as well as limits the ability to be diversified and allows motion to be involved in decision making. Holding smaller positions allows for more cash on hand, as well as prevents any single investment from taking down or damaging the entire portfolio as well. So why do we say shrink your trade size? Besides the fact there are emotional and psychological reasons, we really need to understand our risk, right? So what do the numbers say? Well, if we have a portfolio comprised of 5 positions, 5 stocks, and each of the positions gets 20% of the value of the portfolio, right? What are the chances, mathematically speaking, not the fact that we think every single stock that we're going to buy is going to go up, but mathematically speaking, if we own 5 stocks and each of the stocks gets 20% of the account value, what are the chances our account goes to 0? Well, it's 1 in 32. Let's take it a step further. What now if we expand it to 10 stocks, all with 10% of the total value in the portfolio? What are the chances the account goes busto? Well, now it's 1 in 1,000 plus. Sounds a little better. But what about 20 positions, each with 5% of the portfolio? Well, now it's a little bit better than 1 in a million. So one of the problems is that people don't understand their risk. Well, if you only have 5 positions in your portfolio and each of those positions has 20% of the entire portfolio, do you think you really understand the fact that you have a 1 in 32 chance of having your account go directly to 0? No, I did not think so. That's why something like a 5%, portfolio allocation, you have a 1 in a million chance of losing your portfolio. Those are much better odds, and those are the kind of odds I like. So what's our rule? As you guys can probably tell, no one single trade can use more than 5% of the entire portfolio. So if you have a $2,500 portfolio, no position can take up more than $125. If you have a $10,000 portfolio, no one position can take up more than $500. And if you have a $30,000 portfolio, no one position can take up more than $1,500. So, if you do these two things, not only will you get filled at a better price, and getting filled at a better price when stocks are down, obviously you have a much better odds of making money. But if the trade or investment does not go our way, the entire portfolio will be less affected. So in a game where we do not have 100% control over everything, right? We can always put the odds on our side by having the proper mechanics around our order price as well as trade size. So, before making a trade, put your order below the market. If you put your order in below the market, not only are you not chasing stocks higher, but you're also giving yourself a fill price that is a better than it was before fill price, and you have much better odds of making money. At the same time, after you have given yourself better odds of making money, now you've shrunken your trade size to 5%. If you shrink your trade size to 5% of the entire portfolio, you have now 1 in a million chance of losing the entire value of the portfolio. So the problem that we spoke about before, guys, the problem is that people throw their money into investments or trades because they feel like they're going to miss out on the next big thing. The way we fix that is to buy when stocks are down, to put our order in below the market. And on top of that, at the same time, those people that throw their money into investments because they feel like they're going to miss out on the next big thing, they do not understand their risk. And the way we can fix that is to have no trade have greater than 5% of the entire portfolio allocated to it. Now, I do these two simple steps for every single trade. Again, they're not sexy, but I'm controlling everything I can control in the stock market. I'm putting the odds on my side. I'm mitigating my risk significantly. I'm taking a lot of emotion and psychology out of the market. And that's what's allowed me to consistently stay in the game and consistently use my mechanics and my strategies over and over and over again. Okay, everyone, thanks for tuning in. That was a really great one. If you're really still concerned that doesn't wet your beak enough or that isn't exciting enough for you, I'm here to tell you it's mission critical. Although you might poo-poo it, there will be a day where your trade size is way too big and you get slapped by the market. That will teach you. But I'm here to teach you to avoid those types of things. Again, guys, the big problem is that people will throw their money into a stock or investment because they're afraid of missing out on the next big thing. And when they do that, they don't understand what their risk truly is. The way I fix that is by following two simple steps before I make any trade or investment. And those simple steps are: number one, I always put an order in below the market. This allows me to buy stocks when they're down. Now, buying stocks when they're down if I buy stocks when they're down, the stock is far more likely to go higher than it is to continue lower. So that's a good thing. And then in order to really understand my risk, as a rule of thumb, I make sure that every single trade, the value of that trade is never any greater than 5% of the entire portfolio, right? This way it will allow me to stay in the game. If I have 5% allocated to every position in my portfolio, I have a 1 in a million chance of losing my entire portfolio. Again, those are two simple things I do before every single trade. They've helped me save a lot of money. They've saved me from a lot of headaches and sleepless nights. I've never had one position go against me so badly that it affected my entire portfolio. And again, it has allowed me to stay in the game. It has allowed me to prosper when things are going my way. And when things aren't going my way, it's allowed those things to not really hurt so much. So guys, do those two simple steps before every single trade. And I look forward to seeing you grow with your investments. I'll see you guys in the next video.